Hey everybody, welcome to Mortgage Today for Thursday, February 8th, 2024, and oh, what a day it was. UMBS were down 15 basis points real early today. Jobless claims came in at 218,000 on a 220 forecast. It was 227,000 previously. The jobless claims number confirmed just how hungry the bond market has been for economic data this week. The results were right in line with consensus, but have nonetheless produced a noticeable reaction in the bond market volume. Treasury Secretary Janet Yellen told the Senate Banking Committee that the government is concerned about the growing problem in commercial real estate. I'm concerned, she said. I believe it's manageable, although there will be some institutions that will be quite stressed by the problem. While the Fed speak yesterday indicated the Fed is not ready to start cutting rates, the banking crisis can change that in an instant. With mark-to-market capital levels underwater, a decrease in interest rates would have the effect of recapitalizing banks quickly without having to resort to a ration of credit. Multifamily commercial real estate is showing cracks, and a deluge of supply is coming to the market that should stabilize or even push down rents, which will flow through to the inflation numbers. Consumers are becoming more optimistic about the real estate market, according to Fannie Mae Home Purchase Sentiment. For the first time in our national housing survey's history, a greater share of consumers believe mortgage rates will decrease over the next year rather than increase. Consumers also expressed greater confidence in their job situations this month, another sign that housing sentiment may improve in 2024. New York Community Bank is looking to lay off some of its mortgage risk at Flagstar. Flagstar was known primarily as a correspondent buyer of conforming loans, so those are all credit guaranteed already. I am guessing they are jumbo loans, since Flagstar wasn't big in the non-QM space, if at all. They were big buyers in the 2 to 4 unit mortgages when the GSEs capped the number of multi-units at 7.5 a couple of years ago. It wouldn't be the first time, and probably won't be the last time, that the bond market finds itself in a lull during the week that separates the most significant top-tier economic data. Last week's NFP swung for the fences in a bad way for rates, but it's not game over unless next week's CPI proves to be a bash brother. Between one and the other, it's a great time to hit the concession stand. It isn't to say exciting things can't happen outside of the NFP and CPI type reports, only that there's nothing on the calendar for scheduled events that demands attention until Tuesday morning at 8:30. So UMBS ended the day down 6 basis points, a bit of a rally during the day at 100.81. The 5.5 coupon lost a bit more, and the 10-year Treasury closed the day at 4.158. But at the 100.81 number on the UMBS, that is putting us underneath that 50-day moving average, which has converged upon the 25-day moving average, and they've both broken below that really strong Fibonacci ceiling that's been holding up for quite a while, going back into December. So it's going to take some pretty strong data to get us above that. We also got a post from our sponsor at WellThatMakesSense.com. This is from our Yeah But series, where we discuss the pros and cons, the ups and downs, the goods and the bads of the new rules on 2 to 4 unit properties. Are they really as great as you thought they were?